Hello, and welcome to the third quarter 26 edition of the Credit Corner. I'm your host, David Klink, Director of Credit Research here at Meter Public Funds. As always, today I will walk through what we're currently seeing in the investment grade credit market and provide our team's best thinking on how those trends might play out over the next few quarters. So it continues to be notable the low levels of volatility we're seeing in the historically jumpy high yield market, where spreads have barely budged over the last 3 years, even on tariffs and then US-Iran concerns. Though the argument can be made that the Fed has rushed liquidity to the market's aid so many times that the nature of debt investing has changed over the last few years, this seems relatively unlikely given the long arc of financial markets. And so what we're probably seeing is just a reflection of a strong economy. So if high yield spreads aren't moving, then certainly neither is investment grade or IG. And at least right now, it's unclear what the catalyst for such future movement would be. We've been attending conferences and webinars searching for that smoking gun, but no one seems to be able to muster much more than they're tight, so they probably won't be at some point. In fact, rather than seeing credit spreads widen at all, we've actually seen spreads for most of our approved issuers this year heading to a lower range. So spreads are tight, as has been the case outside of a few weeks for most of the last 3 years since the commercial real estate problems of 2023. But we're starting to see spread dispersion, or the difference between high and low sector spreads, creeping back into markets. So, in other words, choosiness is coming back. So, probably predictably, the most notable tightening this year has come from either oil and gas producers or domestic chemicals companies. Those are both benefiting in their own ways from the US-Iran conflict and modestly higher Brent crude prices. The worst performing sectors aren't really that bad at all. They just haven't seen much spread tightening this year. Those are often sectors like banks that saw credit spreads already do their tightening in 2025. So here we show two charts, debt issuance amounts of both non-financial and financial companies to arrive at the same basic conclusion. Issuance has been pretty heavy year to date. And if extended at that pace, would be at some of the higher levels that we've seen in a while. The pace was probably front end loaded pretty heavily. So companies generally have amounts of funding they need to raise for the full year, and then they take advantage of strong markets to issue where they can. Given how well debt markets have behaved this year, this has probably been what we've seen. So it's unlikely that we're going to see this ratable increase for a full year and end quite so strong. But most estimates that we're seeing from some of the broker dealers of full year issuance are only modestly above 2025 levels, and they keep raising just a little bit going forward. So AI hyperscalers like Google, banks, or those funding an M&A transaction with debt have gotten all the attention, but it's actually been a pretty diverse group of industries that are raising funding this year. So among the banks, we're seeing issuance shift back to traditional senior unsecured and away from regulatory debt, which for several reasons indicate that banks are in a good financial position and backed by investor confidence. So very strong issuance. As last year, offsetting those high levels of issuance are high levels of investor fund flows into the fixed income space. So you're seeing more of those flows that are allocated to fixed income in general, making their way to a little bit riskier credit markets rather than theoretically risk-free treasury markets. So that's another sign of investor optimism returning to fixed income markets after some of the problems that you saw in 2022. So remember our favorite quote, and it sums up the flow environment pretty well. Spreads are tight, but yields are all right. We like to show this chart each quarter to illustrate that non-financials are not levering up at the aggregate level, but like the proverbial swimmer that drowned in a river on average 6 inches deep, the aggregate stats can mask individual movements. And so within a stable aggregate, we're seeing debt levels increase at the triple B and double A ratings categories. Most of that debt appears to be going for arguably beneficial M&A purchases rather than last decade's trend of issuing debt to buy back shares that would boost the stock price. And we also see triple B issuers still well below that generic 3.5x line in the sand that would make them maybe downgrade candidates that would possibly ripple through to single A and double A ratings categories. But as recently as last year, this graph showed no increase at all in the leverage level. So you are seeing some, and we'll have to continue focusing on that going forward. The banks remain in very good shape. Uh, Few troubled loans, capital positions are strong, but not quite as strong as in prior years. And really, any decline that you're seeing is a choice that the banks are making. So the broad theme is that we're embarking on a deregulatory push, primarily in the US, but to an extent in most regions of the globe. And banks are working down that capital position by paying out more than they earn in net income. Reasonable question is, why are you doing this? Why is the US watering down its regulatory approach after making its bigger banks so strong that they easily sailed through most crises of the last 2 decades? Banks say it will free up capital for lending. But we've watched that rarely play out over 20 years, as banks seem to perennially make this argument, never really plays out. Good example, Goldman Sachs made 5.5 billion in the first quarter and paid out 7 billion in dividends and repurchases. You can make idiosyncratic arguments about individual companies like a Goldman, but we think that's pretty illustrative of the broader point. Banks say it'll free up capital, but will it really? Um, so the IG markets remain pretty healthy, but there are some open questions. One is what credit looks like if rates start rising. So we've been raising this issue for several quarters in a row, wondering what happens if rates just stop coming down, let alone rising. They've presumably been artificially boosting some of the credit performances that you've seen over the last year. So what does credit look like going forward? The next is the generic what's lurking behind the next corner question. No one has any good ideas, but that doesn't mean nothing exists. We saw several banks with slight credit weakness in 1Q. It was mostly related to a couple outright fraud cases they had with a prominent borrower, or what the banks insist is just credit normalization. We'll have to see if that's really the case going forward. Will we see more hiccups or even worse? Will some of the hiccups that we saw in 1Q still be hiccups in 2Q for like a Deutsche Bank or an HSBC saw some weakness? So we'll have to continue monitoring the state of the hiccups, if you will. We've also seen market hand-wringing over private credit lose steam over the last few weeks. Even as we continue to see the Apollos of the world limit redemptions in their private credit funds, we think this comes down to greatly improved disclosures by the banks and life insurers on their 1Q earnings calls. And finally, we're seeing significant market concerns that the extreme levels of AI CapEx will result in white elephants. So there are a few questions that we need to keep trying to answer entering the back half of 2026, but in general, IG credit markets are looking pretty healthy right now. I hope you have found this edition of the Credit Corner informative and look for future quarterly updates of this content. Thank you.